if you don't bet on exceptional founders, you will fail. We'll never give up until sometimes things just don't work. So we are a really white glove, high touch model. As a startup founder, you need to really get good at getting shit done. We're there for them for the whole journey.
At Context Ventures, our podcast, Advancing VC, covers all things startup and venture capital, primarily how startups and venture capital are changing. We chat with venture capitalists, limited partners, and founders who are actively working at the frontiers of our industry and are advancing venture capital. Today, I'm especially excited to interview Jeff Clavier of Uncork Capital. Jeff, thank you for joining us.
Thank you for having me, Tim.
Jeff, can you please share the founding motivation for starting SoftTech, now Uncork?
Wow, we could spend an hour on that, but essentially, when you go back to 2004, the market was, angels writing small checks and not really helping entrepreneurs, VCs writing larger checks, $1 million, $2 million, that was the norm at the time. And there was nothing in the middle, which we call seed today, to help entrepreneurs with small checks and a lot of help. And so I saw this gap in the market, and so did my fellow original, gangster sort of seed sort of friends. And so decided to leave my job as a general partner at the Reuters Greenhouse Fund, start SoftTech VC, now Uncork, and essentially for 3 years invest my own capital. So we had made a little bit of money when we had sold our startup to Reuters, and so started making 25, 50K sort of investments and helped founders go from what we call today the pre-seed phase to Series A for, call it 3 years. And then in 2007, we raised $15 million, what we call Fund 2, which was one of the first seed funds in history.
That cohort of seed funds, I think of Floodgate, True Ventures, Felicis. Am I getting that right, or am I missing any?
So Felicis came a bit later. Iden was certainly a very active angel a couple of years after us. Floodgate, definitely. True Ventures, obviously first round.
Yes.
Those were sort of the OGs that were in market at the same time I was.
And seed, a few years ago, I'd say 5 years ago, was the first check. Now, Charles Hudson, Hustle Fund, Everywhere Ventures, ourselves doing pre-seed investing.
Yep.
How much does Uncork do pre-seed investing?
In the early days, we were sort of the very first check, right? And for 6 years, I was a solo GP, so I refer to we as me and then, my team. And so for the first 6 years, we were kind of the incorporation check. And then as the funds that we raised were getting larger and larger, we started to do sort of later sort of seed, and that gave the opportunity for the pre-seed firms to become sort of the first check again. And that's why sort of Charles, who was my partner for 5 years, with my blessing, start sort of precursor. And then I would say, because I really want to invest in a product more than a team, but my team and I now, I would say, do about 30% pre-seed and 70% seed.
This might be a bad joke, but do you think there's going to be pre-seed or pre-precursor, given how I feel every 5 to 7 years, people just gravitate towards larger funds and so on and so forth?
Well, you'd have to invest in babies because, by definition, precursor invests at scary early stage, as Charles sort of calls it. I think you could, try and kind of invest in people before they have any idea. So that would be sort of the pre-seed, which is what some people have tried to do, especially on the influencer side. It's like, okay, I'm going to back you because I think that you'll become awesome, right? And you figure out a deal where you become an investor in whatever they create. The seed OGs revolutionized, the world of VC by creating something that didn't exist. And then people have started to sort of, riff off and iterate on that. So I'm not predicting anything. We'll see where sort of people go. As far as we're concerned, because we write a large check, we're not a fund that's going to do sort of 100 investments per fund and then figure out who's actually sort of performing and then back them with a bunch of money sort of later on. We only have a $225 million seed fund. It's kind of large, but it's small as well. our motto is really to either invest in proven entrepreneurs, and so the pre-seed bet that we make tend to be in slightly more established or maybe repeat entrepreneurs. But we like to sort of invest on a product and a little bit of market input as to whether there's actually someone who wants to use this thing and pay for this thing and will scale, the usage of this thing.
It's been over 20 years since you started
21 years,
soft tech.
This May. Yep.
What has surprised you the most about venture that if you asked yourself in 2004, you'd be like, no, that's incredulous, and it's actually played out to be the case?
My dear friend Josh Koppelman had sort of a vision that the seed world would potentially sort of flourish into what it's become, whereas to me it was like a cottage industry. And if you ask me, from the time there were like 50 people around the room that represented all the 50 sort of seed funds, it felt crowded, right? And to me, my question has always been, well, at some point, there's a lot of potential performance to go around, but for everyone to be successful and to create a massive sort of success kind of firm, you need to be in the right deals. And so as the industry sort of blew up in proportion, in size, right, going from 25 to 50 to 200 to 2,000 sort of firms, I understand why it's tempting to want to be a seed stage VC, but I don't think people understand how hard it is. And we'll see whether we continue sort of scaling in size or whether we start shrinking.
Over those 21 years, you've invested in over 280 companies, you and your firm.
Yep.
What are the hallmarks of great companies, say Fitbit, SendGrid, Eventbrite, Postmates, Vidyard, Poshmark? Like what makes those companies stand out?
I think that those were sort of incredibly sort of smart founders who had really a certain sort of vision of the future, and they managed to go from visionary to actual execution kind of managers, leaders, because you can't only be a visionary all your life as a startup founder. You need to really get good at getting shit done. And so A, they had the right idea. B, they figured out how to sort of take this idea to a product that the market sort of wanted. They figured out how to scale the product. And as you go from 1 to 10 to 100 to $1 billion in revenue, it's not the same product, it's not the same go-to-market strategy, it's not the same team. And you basically have to figure out how to refine both yourself and the team surrounding you to make it sort of happen. And the people you mentioned sort of are the guys and gals who managed to sort of figure this out.
What type of founder support does Uncork provide in terms of its portfolio companies? From
the early days where it's going to be refining sort of the idea. So you have a vision, so you need to sort of turn a product into it. Then you need to hire the team that's actually going to start executing. Then you need to figure out your go-to-market strategy. Then you need to sort of rinse and repeat and test a bunch. And over time, we'll sort of grow with you and change the way we sort of support you. And we'll go through the key hires, the key pain points, the key decisions where like, okay, well, this used to work and now it's no longer working. So what do we do? What do we change? And so on and so forth. And then eventually we'll help you with the exit, which will be like, okay, so how do we run an exit process? How do we run an IPO? A lot of the things that people typically don't talk about is also being there for the founder, the CEO, and sometimes the CEO is still the founder is still the CEO, and sometimes it's no longer the CEO. So you have to help the founders with that transition. It's to be there for the founder and their team to figure out how to deal with personal issues, growth, scaling, which it's pretty sort of hard to find someone to confide with about the uncertainties, the personal aspect. We're there for that. So all those companies in the portfolio today, I invested in 2008, and I'm still talking to the CEO on a monthly basis. And whenever he has something that he wants to talk to me about, he just texts me, and we chat, and it's very different. It's about financial performance. It's about cash and runway and hurdles and strategy, and so we're there for them for the whole journey.
one of your core values is integrity comes first, and you prioritizing product market fit above anything else. What are the other core values of Uncork?
I mean, there's this Galaxy Quest quote, never give up, never surrender, which I kind of, thank you. We sort of seek this walk through walls kind of attitude in our founders, and we try and also, have the same approach, and we'll never give up until sometimes things just don't work. And yes, we've invested in, 280 companies in the past 21 years, and probably, half of them failed, which means that, we had to go through our kind of share of shutdowns and wipeouts and things that didn't work. And people always sort of tried until they decided that they were done, right? And we sort of respect that. And we also sort of support them in that decision that they make. And we help to sort of get out in a as clean as possible kind of situation.
I'm curious how your mindset and your firm's mindset around board observer has changed, because seed used to be pre-seed. Now you all come later. Like, how do you and your firm view board observer?
We're definitely in the camp that thinks that early boards are really useful, because it's kind of useful for entrepreneurs to have a mini board, a baby board, which they control. It's never about us being sort of in board control, because we can't, right? The typical sort of board structure when we invest is, 2 common seats and 1 preferred seat. Sometimes it's the CEO and a co-founder. Sometimes there's, 3 co-founders on the board. It doesn't matter. It has to be sort of in the control of the founding team. It's just good hygiene to sort of get in the rhythm of having a board and reporting and so on and so forth, because that's what's going to happen when sort of Series A's and Series B's sort of happen. We don't mandate it. YC has basically, sort of brainwashed companies saying you shouldn't have a board at seed stage, and we go with that. But we think when we put down a term sheet for a seed round that is done with equity, we always offer to be on the board, and our approach is to typically be there until the Series B. So we're on the board at seed round, Series A, and then when a Series B investor comes, sometimes they sort of take our board slot, and sometimes we stay. So we tried to, especially as Series Bs used to happen sort of earlier in the life of companies, now there is a pre-seed and then a seed round, then a seed extension, and so on and so forth. And basically you end up with founders that are fully vested before the company has raised a Series A. For us, if the company sort of actually raises a Series B, it's much later. And so it's a good time for us to roll off and focus on our early stage portfolio.
What's a reasonable number for an investor to be on number of boards?
Give or take, between 10 and 12 boards, and things show up, die, sell, whatever. So it's a moving target. I think it's about how you structure your work and how efficient you are at it. I would say probably 15, it becomes sort of a lot. But I have friends who have 20 boards and they're still, adding value. So it's really sort of a personal preference and sort of how you structure your work kind of thing. Some people essentially do most of their work around, board meetings. Whereas I do a lot of side interactions with my founders. And so I try to sort of keep it down.
I find early stage, and more importantly, I want to hear what you think. Most of the work is done not before the board meetings, it's done way before.
At seed stage, a board is essentially a slightly more formal version of the daily, weekly, monthly interactions that you have with your founders. But it's good to sort of step back and look at what was the plan, what have we achieved, what are the differences, what do we need to fix, what do we need to work on, what are the key initiatives, and so on and so forth. Because it's really sort of easy to just work, and never sort of step back and try and have sort of a higher level sort of conversation. And also kind of a longer term planning in terms of, okay, we just raised the seed round. Well, let's just start talking about the Series A and what it will take, a couple of years from now to raise a Series A. What are the hurdles? What are sort of Series A VCs looking at today? And sort of keep in mind that every day that passes, you're burning cash there's money being set on fire, and runway is always short, or it's always sort of shorter than you think.
Seed investing has become more quote unquote institutional. How much do you feel like the Series A firms are coming down to seed, or mega firms are coming down to seed? And so it's not just, hey, Floodgate's looking at this first round in True, but other firms.
In the early days, they thought that we were cute, right? And so they looked at us and they were like, well, what are those guys doing? And they, pretty much sort of worked with us as just Series A deal flow, right? And they were very, very happy with that. And then they figured out, well, this is actually sort of interesting. And so you had 2 or 3 times Series A firms sort of created structures or seed, funds or seed partners, and then they realized it was a bad idea, and then it was a good idea again, and it was a bad idea. So they ebbed and flows. Today, I would say, doesn't really sort of bother us at all. We win north of 90% of the deals that we offer to invest in, and unfortunately, it is what it is. The only times where we really sort of lose something is, an Andreessen Horowitz or GC sort of decides to put down a $10 million seed round and 100 posts, and we're just walking away because we don't do those, right? So that's the way to outcompete us, because there's a size of check and price that we won't go after. I'm not saying that this is right, I'm not saying this is wrong. That's definitely something that they can do. The challenge for founders is to figure out, okay, if I have a $1 billion fund that gives me, $2 to $3 million check, how can I get the same level of attention, support, input, work from the deal partner? Because that person probably has $50 million allocation to move per year, and it's hard to move if you do $2 to $3 million checks. Whereas for us, that's the only thing we do. And yes, they have very large platform teams that can work with you on, PR and marketing and hiring and so on and so forth. But those aren't the deal partners. Those aren't the people who will sort of help you build the company. So that's why we're like, hey, at the end of the day, you do what you want, right? You do what's best for your company, but work with someone and it could be us or first round or many of the super high quality firms that will actually lead around, not only put some money and put their name on the cap table and try and be helpful. It's the people who will actually be there, and you will sort of remember and tell them 10 years down the road, I wouldn't be there without you. You want one of those firms to be leading your round and be solely dedicated to your success at seed stage. And yes, the price will typically sort of be lower, and the size of check will be, slightly lower as well, but you will get all the focus and attention. So it's your choice.
And you probably get diluted less. And maybe those bigger firms, that's an option play for them.
When we invest at pre-seed stage, so it's founding team, or seed stage, which is looking at the early product, we don't know in a competitive market that the company we're backing is the winner, right? And if a multi-stage firm, makes a seed bet and puts money in the wrong company and essentially has to probably forego the investment in the winner, unless they're assholes and they invest in, competitors and therefore create all sorts of issues internally, they will basically sort of have this early bet that will prevent them to actually betting on the right company. And so many times over, this has happened.
I want to talk more about the mechanics of sourcing and seed. But I think what I heard is that in good times, the tourists come into seed, in bad times, they leave. Maybe that's one of the takeaways. And second is more a question.
I'm not sure I would call them tourists.
Okay.
I don't know that tourist is the right word, because if you look at a lot of people who have joined the seed world, they're always super smart, either people like me and my partner Andy, former angels, operators who have sort of become institutional, or people who just decided to go from straight operator to being VCs. It was for, I think what we showed in the early days of the seed world by blogging about what we're doing, because I was also one of the early VC bloggers. We were just blogging about, starting a firm, investing, and so on and so forth. For the first time, we kind of opened the aperture on what it meant to be a VC, and that it wasn't sort of that hard. And with some LPs who were ballsy enough to back people like us in the early days, they sort of showed that there were returns to be made. And suddenly, it wasn't as big of a deal as it used to be to start your own firm and to raise your own funds. And that's why suddenly the halo effect was created, and people sort of started joining and more and more. And then we started having, awesome platforms like AngelList that made it so much easier to manage a fund and to raise money and so on. So like there were a lot of improvements, tools, and willingness to take risk at this early stage, and people sort of joined. The problem, I think, is it's just hard. It's hard to build, it's hard to scale, it's hard to be successful. Like I always joke that carry is this thing that everybody talks about, but only very few have actually seen, carry checks. And as the time it takes to get a company from inception to a public company exit, goes from 8 years back in 2015 when I got Fitbit public, to now when you hear Wealthfront going public at year 17, right? Like all that means that the funds and the people who've invested have, it's almost like a generation, like you have kids that go to college, right? And so mentally, the time it takes, the gray hair you get at waiting for this is not something that everyone kind of signed up for, because a lot had this impression that it would be fun, it would be a quick buck. Unfortunately, investing at seed or pre-seed is definitely not a quick buck.
When we talked a month ago, briefly, I was saying at pre-seed, it's very easy to define. I joked, no revenue, no product, no customers, no team, no problem. What is a seed company these days? Is it 500K ARR? Is it $1 million ARR? Is it 50 customers, no pilot customers? What's a good definition of a great seed company?
It sort of varies, because some people have bootstrapped. It's rare to bootstrap these days, but some people bootstrap, and therefore they start to raise with a couple of pilots, and so no real sort of customer, no revenue, maybe like 5K here, 10K there, a bit of an RE or whatever. And some they've raised like $1 million or $2 million in pre-seed, and they come to us and they have a handful of customers that we can do diligence, maybe a few 100K in ARR. Some have actually sort of a long enough cycle where we can sort of look at churn and people actually being able to retain customers and so on and so forth. We do a little bit of kind of metric analysis, even though it's all over the place. For us, we look at usage and we talk to those customers and we ask, why they use this company's product, who else they sort of looked at, and what's their expansion plan, right? Because everyone starts with something small with sort of a view that they will expand across the enterprise and hopefully scale as their customer is successful. We don't really have sort of preference between companies that sell to other startups versus companies that sell to established industries. We've been successful in both, but obviously in a world where startup mortality is going to be much higher than used to be, you want to make sure that suddenly you don't just get blown up because all your clients didn't manage to raise their follow-on capital.
Where are high quality sources of deal flow for Uncork?
They're everywhere. We don't really sort of have any one source obviously our strongest source is our network of entrepreneurs. So over the past 20 years, we've backed 1,000 startup entrepreneurs, execs, teams, and so on and so forth. So they know us well. They know what we invest in. They know how we work. So they are always a very strong source of referral. We've been working with a tremendous sort of network of co-investors, both on the angel side and pre-seed funds and other firms and so on and so forth. This is sort of also sort of great source. We pay attention to all the established sort of accelerators, incubators. So, whether it's YC, whether it's NEO, whether it's, all that. And we try and figure out, because we're such a low volume kind of firm, we see thousands and thousands of opportunities coming to us every year, and we invest in 10, 12 per year max, right? And we're 5 investing partners, so each partner will do 2 to 3, 4 deals. And so we're really sort of very measured, and the bar is very high for us to sort of make those investments.
You all have been known as a frontier tech firm for a while. I would say Fitbit falls into that. Loft Orbital definitely falls into that. These days, it might be reclassified, or some people say deep tech. Obviously, AI is big now. What are the industries or sectors that really excite Uncork right now?
We're one of a few kind of super broad firms, because that's how I started investing in pretty much everything that I thought was interesting. We don't do kind of drug discovery, sort of bio kind of things. In the early days, soft tech was really more like backing Web 2.0 entrepreneurs, right? So it was mostly sort of consumer. Then in 2007, started doing a bit of SaaS with SendGrid. 2008, I had this kind of question, which was, hey, could we build a hardware company on the cheap, like capital efficient? And then I met the Fitbit guys, and I was like, well, I don't know whether this is sort of the product. I mean, I like the guys a lot. And it wasn't clear that the product, and I still sort of carry it today, was the product that I had sort of in mind, but I decided to sort of invest, both as kind of a thought experiment to see whether you can apply capital efficiency to hardware. And that sort of got me to think about this other horizon of investments where you sort of invest in things before there's a defined market for it, right? And that's what I did with sort of Fitbit. And then I started to do that. That's how we come up with our frontier kind of definition, which is I invest in sort of markets which are not a thing yet. And you could argue that, we announced my latest investment in a company called Cubes, which is additive manufacturing applied to shoewear. And essentially what those guys have is, 2 rooms sort of the size of the one we're here in, which is full of, printers, 3, one on top of each other. And they just spin up, shoes for the shoe industry. And they're not the first to do 3D printing applied to shoes. It's been, tried for the last 10 years, I would say. But no one has figured out how to do it at scale. And I think those guys have an approach that will make them sort of win this kind of reshoring of the shoe manufacturing industry that won't work for all types of shoes. But the shoe market is about $480 billion per year. So 1% slice is about 5 billion, give or take, right? And so I don't know how many slices of 5 billion they can actually own, but there's a few. And that's why I'm super excited to work with Kuba Kratchik and his team in Ventura. To me, it's always like meeting the entrepreneurs who have sort of a different approach and different vision for either an existing market or reinventing a market. And I think that Cubes is a good sort of market reinvention example.
I want to do a pre-seed seed comparison, and this is not a fair one, but Charles, when he came on the podcast, said he's 70% founder, 30% market, just because of where he invests in, and obviously his investment philosophy. How would you classify Uncork? What percent?
It sort of depends so much on the founder and the market they operate in, but I would say it's still at least 60% founder, 30% market, 10% what they've already sort of accomplished. But it sort of depends on how much they've accomplished. So maybe the 10 will sort of scale a little bit. But for us, like, it's so hard to raise capital and to execute. If you don't bet on exceptional founders, you will fail. And so the bar on the founder side, like I'm really super excited by the caliber of the founders that we've backed in the most recent sort of Fund 7, because some are really sort of exceptional. We'll see whether they fare better than their sort of fellow, Fund 4, Fund 5 sort of founders who are been at it for years now. But we really think about like the caliber, the ability, the attitude, and yes, we look at what they've accomplished as just a work product of their ability to execute, but we spend a lot of time, referencing founders and spending time with them.
Your journey over the past 21 years has been personal investing, pre-seed/seed investing. You've done 280 companies. You just mentioned now you all are doing about maybe 10 to 12 companies a year, so a much more concentrated portfolio. In the past 2 weeks, at least on my LinkedIn feed, there's been a lot of talk about number of companies that a fund should invest in. I think there's no one better than to ask you, given you've done big funds, small in terms of number of companies, smaller concentration. What's your take on how many investments a fund should be doing?
That's a really hard question to answer because it all depends on your strategy, and there's probably 10 or 20 winning portfolio constructions, but they depend on the size of the fund, depends on your sort of market positioning and like the kinds of companies and stage at which you operate, right? So for us, it's just a math issue, right? We're gonna buy 10 to 15% of the companies we invest in, right? We're gonna try and maintain our ownership for at least 2 rounds of financing, right? But that still means we're gonna dilute a little bit, which means that our terminal kind of ownership when a company exits or IPOs is probably in the 5-6%, sort of range, right? And so we need multi-billion-dollar outcomes in order to return our funds. And we know that based on historical data, we always sort of have, 3 to 6 winners per fund, right? And so and some, will be smaller, some will be larger, but in order to get a 5x plus sort of fund and then some, right? That's what you need. And therefore, we want to have a manageable number of portfolio companies that we know have a high chance of, having a transition to Series A and Series B and so on and so forth. And we used to have like a 85% election rate. We'll see in this incredibly sort of tough market what it becomes, right? But we built our strategy, portfolio construction, reserve strategy based on what we do and how we operate. It's not a critique. The comment I made to Charles when he sort of told me about his strategy was, here is what Precursor is going to do. I'm like, dude, I don't know how you're going to manage 100 or 80 companies per fund, and given your ownership, how the math sort of is going to work. And we'll see, right? I wish him well, obviously. And people will sort of say, well, but how can you be sure that the 10 companies that you elect to invest in will work versus doing 20, right? It's more shots on goal, right? And so we are based on, a concentrated sort of set of bets in which we write large checks and we go all in.
Your feedback on number of funds and ownership and how you can return the fund. I'm curious on flipping that question a little bit and about the amount of time you can spend with companies. At what point do you feel like it is really difficult for a fund manager? In full disclosure, we're going to do about 50 in our fund. That you really just don't have the time. It's not even about ownership. It's about time with the company, time with the founders.
You don't want to have to babysit founders. If you have to babysit the founder, it's pretty bad news, right? And so at the end of the day, it's really like, how can you spend like the time you need to help the founder, support their decision making and be there for them, when they need it. But it's their job to do the work. And before this, I was with my friend Jeff Lawson at Twilio, ex-Twilio, and we were just chatting about this. And he was like, well, I never really sort of called my early stage sort of VCs, and one of them sort of, my other friend Manu Kumar at K9, sort of complained almost that I wasn't calling him, sort of often enough. But it's because we're there to just make sure if you have a key decision to make, you just, call us. You don't have to, but you should, right? And so for you, the question is, how can you allocate your time across your companies and either do it on a regular basis or make sure that the founders that work with you know that whenever there is a critical, decision to make, they should call you. The thing is, especially with first-time founders, they've never done it before, and they will fuck things up without knowing. And if you have a chance to just chat with them about, operational things or whatever, like, you will sort of, because you're just chatting with them regularly, you will catch things and help them fix those before they become really kind of potentially dramatic.
So I'm going to ask a hard question. What's the max carrying capacity of a pre-seed fund in terms of number of companies you think they can truly like influence and impact?
Once again, it depends on how they sort of get involved. I think there are, for us, we are really white glove, high touch model. And so that's why we think that 35, basically sort of adding, call it 12 companies a year to the portfolio, right, works. And what we've done is we do a lot of work, as partners, but we also have now a platform team that helps our founders without us actually spending time with them on the talent side, on the finance side, on the, external sort of things, PR and so on and so forth. Like all that doesn't involve me or my partner's time. It's really sort of pushed to our incredible sort of platform team. So we've sort of found scale in what we do. If we had to do, call it, 50 investments, per fund, we would probably scale 60 probably. But, at some point, like the number of boards, the number of relationships, like, the number of calls that you have to place per day or per week becomes sort of really heavy. And you want to, I'm really fighting to have free time, not so much because I don't want to do anything, but this is free time that will be just used by founders that need that, emergency phone call or text or email or presence or meeting, because I know it happens.
Totally. Thank you. Another thing that's really transformed over the time of the 21 years is this notion of a solo GP. And Arthur Rock was one, you were one, you grew out a team. These days, there's feedback that, solo GP too dangerous, or solo GP, actually technology has enabled that. I'm curious, as someone who was a solo GP and who has grown a team, your thoughts on this dynamic.
Back in the day, so you had Chris Duvos, right, old friend of mine, on your podcast. And I remember our conversations back in 2007 or 8 about the risk of solo GPs and the fact that what if you go under a bus and so on and so forth. And so I had to figure out in my structure as a solo GP, if something, God forbid, happened to me, who would be kind of the trustee of the organization. And I had, sort of figured that out. And so for the first few years...
Morbid planning.
Well,
but necessary.
You have to face it, right? Yeah. It was like during COVID, like as the solo managing partner, if something happened to me and during COVID, it could, like everything stopped. Like no check was being signed, no documents were being sort of executed or whatever. So I basically sort of had to write a business will, which said that if my wife and my assistant deemed me incapacitated, then Andy, my partner, who's now the sole managing partner of Uncork, would become the signatory of the firm. That's a fun, conversation to have with your, with your admin and your wife, but you have to, right? Planning is part of what we do. So being a solo GP was really, really tough because of all the risks involved or whatever. And then I'm a single child, so I'm used to sort of play on my own, but I thought that it became kind of a bit lonely, but also it's always good to have someone, super smart, to have like alignment, but different ideas. And that's why in 2010, when I started to raise our second institutional fund, so Fund 3, as we called it, I went to Charles, and because Charles was the smartest person I knew who was going to be compatible enough, but different enough that we could actually sort of be, 1 + 1 = 3. And I said, hey, will you sort of partner with me on this thing? And we started, building a team, and I brought in, my then assistant, Ashley, who's now my head of operations and platform, 15 years later. And we started building this sort of nucleus of, okay, the team is actually what Uncork is made about. And so now, 21 years later, we have an awesome team, half on the investment side, half on the support and platform side. And I couldn't be sort of happier and prouder of every single person who's on the team, because everybody contributes, their point of view, their specialty, and everybody has a voice. And people always ask me, like, how do you guys make decisions that you and Andy sort of figuring out, which deals get done, so on and so forth? And I'm like, no, everybody has the nuclear sort of button to kill a deal. But because you give everyone the ability to kill a deal, actually no one does. And that's what you want, because you want things that are really, really sort of rough, tough, hard to sort of, figure out. If one of our partners is really passionate about making a deal happen, we'll throw everything at him or her to try and convince them this is stupid. But if they want to do it, they will do it. But if ever it fucks up, they'll hear from us.
I'm very curious about sustaining longevity in venture. So with Chris Duvos, he's mentioned oftentimes that venture is a heartbreak business. You will constantly get your heart broken. I'm curious, how have you been able to sustain a fantastic career, and how do you think that'll play out in the next few years too?
So it starts with, having good enough performance to actually sort of, get LPs to continue investing behind you. Because without that, you can't. It's having, sort of this kind of longevity and as a fund manager, you have to sort of decide what's going to be your horizon, right? Like, how long are you committing yourself to do this? Because it's really, really hard. It's hard work. It's, long hours. It's nights and weekends. Entrepreneurs don't sort of call you or need you from 9 to 5 from Mondays to Fridays, right? So it's really sort of intense. And whenever there is an issue, you're sort of deep in it, right? And there's a lot of issues, of course, especially when you have a large portfolio. There's always something that fucks up. Therefore, you want to sort of think about, okay, how long am I committing myself to this, trade, and how do you want to deal with it? Like, what happens when you're kind of done? And it's either you build a legacy, which is basically what I decided to do by passing the torch to my partner Andy, where I basically groomed him to become sort of the managing partner, and then he became the managing partner just a few weeks ago. Or you basically sort of, you're done. You could quit. Like, my friends at Foundry just said, hey, we're not raising another fund. We're now managing the portfolio, and we're done. And so you want to sort of figure out what your strategy sort of is explicitly, as opposed to sort of letting, things happen where, oh, well, we're going to raise another fund, so I guess we're done, right? And so it's having sort of the motivation. This is like having the opportunity to meet incredible entrepreneurs on a daily basis and see the future through their eyes is something that, makes me want to wake up every day, and that's a real privilege. But at some point, you want to figure out, okay, how long am I going to do this, and act accordingly and plan accordingly. And I think I'm sort of a planner, and that's why sort of people sort of said, how long have you been, planning for Andy to take over, right? And I would say this is probably something which I've been working on for the past 5 years, right? For people who think about, hey, this is what I want to do, this is my transition. It's not something that happens, overnight, and you can sort of decide on a whim, because you have founders depending on you, and you have limited partners sort of depending on you. Some people will, sort of do differently. My friend Eric Paley at Founder Collective, an incredibly sort of successful VC, so decided to leave his platform to become a public servant, which is admirable, but I'm sure it came at great shock to his founders and his LPs. Not saying he's wrong, I'm not, but I wouldn't have done this. That's not my way of doing it, and that's why I've been planning my own sort of exit or partial exit or step back, whatever you call it, for a while, and it will take a while, right?
You said to start the last response, in order to do this and have longevity, you had to have performance. I've been told, and I paraphrase this now, that Fund 1 is a pre-seed fund. You pitch a vision. Fund 2 is a seed fund. You pitch paper returns. Fund 3, you have to have real returns. There's like a Series A. There's a big graduation rate. Like, how true or untrue is that? I don't know. I'm curious.
It's actually not a bad kind of analogy, but essentially the issue that we all face, as we discussed, right? The time it takes to get outcomes has doubled or tripled, right? The thing that people don't appreciate is that when me and the boys sort of got started, right? There was just this moment in time where Web 2 companies were sort of innovating on user interaction and UIs and so on and so forth, and a lot of those companies got acquired super quickly by the Web 1.0 companies, so the Yahoos and the AOLs and the others, right? And so by the time I raised Fund 2, my angel portfolio was already 5x DPI, right, in 3 years.
Very nice.
And so, yes, but the point is that never fucking happens, right? That was a moment in time kind of thing, which means that we could show not only that the strategy on sourcing, building, follow-on investments worked, but also we were actually making a bunch of money, right? And so we got lucky that we started so early that we kind of took advantage. And it's not that we didn't, like, there was this concept of build to flip, right? Where you said, well, I'm building a company to flip it, but it never sort of happened. It's like, I invested in Truvio, which was a pre-YouTube video search engine. So you were scouring the web, right, using crawlers to sort of figure out where you could find a video player, and that was a hint that there was sort of video behind it. So we created that search engine. And the company, who was started by two incredible sort of founders and technologists, essentially was at the nexus of a bidding war between AOL and Fox Interactive. And within 10 months and 3 weeks of investing in it, we sold it, for 50 million. So not much, but because we invested at 2.5 pre, we did, 17x in less than 1 year, which means we paid short-term capital gains, which sucked. But anyway, the point is, like, this was a truly remarkable sort of team and company that was just gobbled sort of super early, because at that time there was like, the acquirers were looking at companies that were raising a Series A and see whether they're going to buy them beforehand. So we were just there at the right time, and so we could show, like, not paper returns, but actual cash on cash, hardcore DPI. And that's why when we raised, follow-on funds, there wasn't a question as to whether strategy was working. The question was, well, that worked because you invested 25 to 50K, but now you want to invest 500K. Is that going to work again? And so every time you change something in the makeup of your investing strategy, LPs are going to start doubting that whatever you did is no longer going to work. And the big sort of new mistake I made when I went out to raise Fund 3 is I changed every single thing I could change from Fund 2. Size of the checks, the size of the portfolio, sectors were the same, the team, because I was no longer sort of GP, I was with Charles. And so, like, there were like a lot of moving parts, and LPs hate moving parts. Once they see something that works, typically they want to basically do the same. If you want to change something, change one thing. Don't change like 2 or 3 or everything, because you will sort of pay the price in the time it takes to raise this fund.
I find the similarities between founders and VCs similar in terms of what got you here won't necessarily get you there.
Yeah.
You've had an amazing run at venture. There's still so much more there. Thank you for sharing. I'm going to wrap this up in some rapid fire questions. Favorite movies?
Recently, Top Gun Maverick.
Is that better than the first Top Gun or not?
Yes.
Favorite snacks?
I'm super eclectic, so some kind of French snack Salami, probably.
Favorite books?
June.
Are the movies, the latest movies, better than the book?
Oh, no movie sort of made real justice to the books because it's like, 2,500 pages. But I think the Gilles Villeneuve's version is pretty good. Though I still like the original sort of Dune, and actually met Cal McLachlan recently for breakfast, and is an awesome dude. So yeah.
Amazing. That original director was, he wrote Brazil.
Do you know the Atlantis? No?
Oh, yes. No, I don't think he directed Brazil. Favorite leaders, historic or present? Business, political?
Winston Churchill. I'm just making this up, as I go, but
That's a good one. Jeff,
he's an incredible sort of leader.
thank you so much for taking the time to chat.
Thank you. Thanks for having me.
I loved your interview. My question is, like, you have had such a long journey here. How do you, I don't want to use the word pick the best people, but how do you find great people and stay in connection with them?
So as for my team or for the startups to work with?
Both.
After so many years in the industry, you basically sort of try and you develop a bit of a spidey sense on people, and it gets wrong really, really badly, which is annoying. But sometimes you meet people and you're like, kind of, you feel that they are the right fit for you, either as a startup founder or as someone to join the team. And then you sort of, your gut feel gets you to be super excited, and then you spend a bunch of time to confirm the gut feel, as opposed to meeting someone and feeling kind of okay, and then you sort of build up in terms of enthusiasm. At least that's the way. Like when I met for the first time our head of talent, Adriana, I thought she was probably the best head of talent I had ever met, and she's an exceptional sort of chief of people, and essentially everything that we heard about her, and kudos to my partner Andy to have secured her and found her, and then gotten her to join us, because originally someone said, "Oh, I know someone who's going to be awesome, but you will never get her," and we're like, "Uncork, of course we'll get her." And so it's the way sort of I sort of do it, because I've met tens of thousands of people by now, right? And so you try to sort of figure out, what are the traits that you're looking for, and once you find someone, you kind of know. That's why, like, very often entrepreneurs, within the first 10, 15 minutes whether they're sort of they are above the bar or not.
Thank you so much, Jeff. Appreciate you. Can you offer any insights on identifying pre-product market fit for some of these companies that you're involved with right now? Because you're looking at so far down the road and you're a product-focused person, any insights you have on that, especially going from thousands of potential players to 2 to 3 deals per year? How do you identify the potential for that product market fit down the road?
That's a really, really hard one, and that's where we spend the bulk of our time, which is, okay, so we look first at the pedigree of the founders and why they can afford, or they're allowed to have a unique insight on a given market. And very often, we were looking at the deal, we just made an offer today, where the founder has spent 7 years in that market, and he's just a nerd about the topic, and he was going like super deep in our time with him. And we thought it was really sort of interesting that someone can get excited about something so boring. It's some form of loans. But the dude is really, really legit. And then we made, a bunch of calls both on him. And what we heard is that in his company of 500 people, he was considered to be one of the top 5 employees. And then we talked to a couple of sort of his early design partners, and they said, look, the reason why we're excited is because we absolutely sort of need this. And if we need this, there's like 100 of us, needing it. And so it's super early, but we basically got to 2 convictions. One, that there was a sore need in the market for this, that the founder was kind of exceptional in terms of, someone who is operating in that particular sort of market and is excited about it. And the one unknown, and we decided to just go with it, is, okay, if they build the product that this industry needs, do we still get a multi-billion-dollar company out of it or not? And we're not sure, but YOLO. So we went for it.
You mentioned a couple of times about how companies are staying private longer. How do you think about liquidity within your portfolio? How do you advise other investors whether to take secondaries off the table or continuing to let them run?
So that's a really excellent question, and that's one we discuss, pretty much every partner meeting. Because obviously, in a world where you, as a GP, are gonna raise capital every 3 years or 5 years, whatever your, fundraising cycle is, it takes, 15 years to exit a company at seed stage. So the time is sort of against you, right? And so you need, as we discussed, to show LPs some real sort of DPI, some hard, cold cash as opposed to just paper returns. So at some point, you need to figure out how to engineer liquidity. And, what Charles is doing is whenever a founder is selling some shares in a Series C or Series, B or C or whatever, he tries to sell some of his shares as well in a structured secondary that is done at, the last round's price or as close to the last round's price. Because the issue right now in the secondary markets is that unless you are an OpenAI or Stripe or whatever, you're trading at, probably 25 to 35% of par, and you're just killing yourself, right? In terms of getting some of those best names, because you can only sell your best names. And if you sell your best names at such a discount, you're going to hurt yourself. And so it's figuring out what's the bare minimum that you can sell to get some liquidity. And an LP will tell you, look, a 1% DPI is way better than a 0% DPI. So moving some money and returning some cash is better than none. We decided to not do it for the last raise, and we managed to raise 300 million in less than 10 weeks in one close, which in this environment is crazy. We're definitely aware that we need to sort of move DPI, and so today we actually sent to our LPs a notice for a distribution of 10% of Fund 5, not a ton of money, but still we're going to return cash to them, and because we had an early sort of liquidity through an M&A, but it's really something that you need to have top of mind.
Thanks for sharing this. You talk about you look at 70% founder and then 20% market and 10% accomplishment.
Ish, yes.
Yeah. Could you give some examples, like when you look at founders that have been bootstrapped versus like founders that have raised like pre-seed and seed? Like I think Team Ali asked you a little bit earlier, like how you look at those a few different categories as well.
It's a tough one because we don't rationalize, like we don't think about, okay, let's spend 70% of this and 20% of that or 10% of this. It's more like how the whole thing sort of comes together. So when we are looking at a pre-seed opportunity, of course, there's nothing. Like sometimes we engage with those founders before they actually have even an idea about what they want to do. It's like my partner Amy is world class at this. Is like she just snipers on someone and goes and say, hey, you're leaving this company, whatever. What are you gonna do? Like, can I give you some money? And they're like, what do you mean? What do you mean? So at that time, it's really like the founder and his ability, to sort of do something sort of unique. If we do like this company that we're gonna make an offer on today that we decided in this partner meeting this morning, they've raised $1 million. They've built a product. It's in the hands of design partners. Great feedback from design partners. Sorely needed. The market check that we got was super positive about the willingness to pay, the absolute need for this. And like I said, of the charts references on the founder, right? And so because we have essentially everything coming together, like great product, sorely needed, the market definitely sort of wants this and is ready to pay, unknown on the overall sort of TAM. And so our risk on this company is the TAM. And then, incredible sort of founder, we decided to go for it. And like for us to get more visibility on the TAM, we probably sort of need to see how the company sort of scales, and we take 2 more years. And because we're a seed-only firm, we never invest at Series A, so we have one shot. Sometimes we pass on something, and we actually passed on that one, funny enough. We passed on it 2 years ago when the dude was using his pre-seed. It was too early for us, didn't speak to us. And now we have, we're lucky and grateful to have a second shot at it, and we're definitely going to take it. And so, we have 1, maybe 2 shots at goal, and we decided to go for it. Thanks for having me.